Welcome to the Fedlife podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the Fedlife podcast. Once again, I am your host, Dan Sipe, and additionally, I'm the branch manager here at Serving Those Who Serve and Lee Sipe and Associates. But I want to begin, as I always do, with thanking you for taking time to listen, and also thank you for your service. You simply do not hear that enough. We are back again with the guru, the incomparable Ed Zurndorfer, as part of our ongoing mission to reach, teach, and serve you. So as always, I have to jump right in here that the opinions of Ed Zurndorfer, no matter how awesome they are his own and provided for informational purposes only and should not be taken for advice. Please seek the guidance of your advisor or advisors before taking any action. So, how you doing, Ed?
Great, Dan. Thanks for having me again.
Thanks for coming back. Today, Ed will be walking us through the Federal Employee Group Life Insurance Program, or FEGLI for short. And as is our practice, we like to try and keep our topics into manageable bites so you can listen to them on your commute, listen to them on the metro, wherever it's best for you. So we'll be breaking this into two parts. The first one that you're listening to now, part one, will be your FEGLI primer, the nuts and bolts of the coverage. How do you get it? How do you change it? And in part two, we will dive into keeping FEGLI in retirement, as well as the lesser known features. So be sure to listen to both. Now, Ed is really pulling double duty for the federal community. He just literally walked in from finishing up his one-day seminar, Understanding Your Federal Benefits, right here in the DMV. And this is 1 week after returning from teaching a 4-day session in Michigan. Ed, you're a teaching machine. How do you do that?
Momentum, Dan, the commitment to help the federal employee community.
Great answer. Ed, I'm really happy that we're covering FEGLI because in many ways, I think it might be one of the more misunderstood federal benefits. As you know, my late father-in-law had misconceptions about it. And after his passing, I got to explain the misconceptions, but I couldn't fix them. So feds out there, listen up, take notes if you like, and be sure to read Ed's latest column in the Fed Zone because they mirror and complement both of these podcasts. Quick little nerd moment here, and I'll take you into a little bit of history. FEGLI was created by the Federal Employees Insurance Act of 1954 and signed into law by President Eisenhower. So I guess that's one more reason to like Ike. So Ed, let's begin with what is FEGLI and how can a federal employee get it?
FEGLI, Dan, is the Federal Employees Group Life Insurance. It is a group term life insurance program available to full-time and part-time permanent federal employees. As a group plan, the good news is when you come into the federal government, you're eligible to get it and not have to furnish evidence of medical insurability. In other words, you could be the best of health, you could be the worst of health. You are guaranteed coverage when you enter federal service. It's a group plan. The bad news is that if you leave federal service, you will leave behind the group plan. You do not carry it with you outside the federal government.
Okay, so while I'm in federal service, it's there, and if I jump on it right away, I can be sick, grab a bunch. There are multiple parts to FEGLI?
Yes, there are, Dan. There is what's called the Basic Insurance Amount, BIA for short, and the Basic Insurance Amount is an employee's salary, their SF, the Standard Form 50 salary, that changes from year to year. It's that salary rounded up to the next $1,000 plus $2,000. So, for example, suppose an employee's salary is $87,200. Rounded up to the next $1,000 is $88,000 plus $2,000 would make the FEGLI basic insurance amount, the BIA, $90,000 for that year.
Okay. And are there parts to it? Does it behave differently for younger workers versus older workers?
For a younger worker who's younger than, let's say, age 45, there's something called the extra benefit,
okay,
in which the amount of their coverage, if they were to die, would be as much as twice as higher if they're at the time of their death, they're 35 or age 35 or younger, and it phases out the extra coverage by the time they are 45 years old. So that extra benefit coverage is only for those employees who die before age 45.
And I guess that makes sense because I'm correct that it's basically the same rate over the course of their career unless they change the whole program. So a 32-year-old and a 62-year-old like me would have the same basic cost of basic, no pun intended.
Yes, the premium cost for FEGLI Basic is the government's paying 1/3 of the cost and the employees are paying the other 2/3 of the cost. And the cost is specifically for every $1,000 of coverage, an employee will pay 15 cents per $1,000 of coverage each pay date. So let's say there are 26 pay dates during the year. So 26 times 0.15 is $3.90. So for over a course of a year, an employee pays $3.90 for every $1,000 of coverage per year, or per monthly, it comes out to be 32.5 cents per $1,000 of coverage. That is the employee's cost.
That sounds like a pretty good deal for
and that's true.
Like
that's a very good deal, and it's true. It's true whether the employee is 32 years old or is 62 years old. There's no increase in costs as the employee gets older. I do want to say this, though, that employees who are in good health pay the same rate as employees who are in bad health. There's no differentiation cost between premium costs for good, healthy employees and non-healthy employees, for young employees and older employees. That which is not the case if someone were to go out and buy individual health insurance.
Oh, very, very true. Very true. And you bring up what's outside of the government. I know in outside policies, sometimes there might be double indemnity or accidental provisions there. Anything like that on FEGLI?
One feature that FEGLI has is called an accelerated death benefit rider, also known as a living benefit rider. And what that means is that if an employee was diagnosed with a terminal disease and had a life expectancy of no more than 9 months, the employee could tap into his or her FEGLI basic insurance amount tax-free and use the money for anything, such as paying off their mortgage, giving a gift to their kids or grandkids, and that rider does not cost anything. It's built into the FEGLI Basic. Some individual term policies have that rider, but the insurance owner would pay an extra premium sometimes for that extra rider.
Sure, and I'm so glad you brought that up because I've known about that since it came in '94, and it was really abstract for me until I got to see how these types of provisions, because you are correct, they are available in private sector programs as well. But I have actually seen situations where people were able to access that benefit and use it for treatments that were considered experimental, and their health insurance wouldn't pay for it, and literally had an opportunity to extend their lives because of it. So feds out there, I know this is really nerdy stuff, but if you don't remember anything of any of the broadcasts that we have here, please remember that. Share it with friends. Let them know that benefit's out there, because most feds don't know it's there, and if you don't know it, you won't use it, and it could really change somebody's life. Also, Ed, if I'm a fed and I die by accident, does my family get more?
Yes, there is called an accidental death and dismemberment feature, AD&D, in which there's extra life insurance proceeds paid out if you die in an accident, or if you lose a limb, an arm, a leg, or an eye. You get the beneficiaries entitled to extra life insurance proceeds as a result of dying in an accident and losing a limb or an eye.
Okay, so if I get hit by a bus, my beneficiaries could get twice as much, and if I lost my sight, I could get a benefit while I'm still alive.
Well, not when you're alive. This is basically for the beneficiary.
Oh, okay.
This is for the beneficiaries.
Okay.
The accelerated death benefit rider is for someone who's still, is for the person who's living.
Okay.
Okay. Yes.
Alrighty. So again, Fedlife folks, remember that that living benefits provision that Ed talked about, let your friends know about it. And I know it's a great thing to talk with your friends about, saying, hey, if you ever get really sick, there's a great benefit on your basic, but it's important. Now, there's even a little bit more to basic, especially some of the nice perks that take place for you in retirement. That's going to be in part 2 of the broadcast. Anything else on basic life before we move on to the options, Ed?
I encourage employees to confirm that they're paying, that they have the right amount of basic insurance amount, the FEGLI basic. And again, using my formula, but they're paying each pay date for every $1,000 of coverage, they're paying 15 cents per $1,000 of coverage. So they should look on their statement of earnings and leave, their leave and earnings statement, and make sure they have the correct amount taken out for their FEGLI basic, given the amount of their SF50 salary and the formula used to compute the amount of their basic.
Okay.
Make sure it's correct.
I
do want to point out that next month, September, is Life Insurance Education Month, and I think this is a good way to prepare for that month, to make sure that they have the right amount of life insurance and paying the correct amount for it.
Gosh, Ed, it's almost like we knew that was coming up and we planned this podcast so it'd be out there just in time.
Yes, timing couldn't be better.
Okay, let's jump to the options. ABC, easiest 1, 2, 3. So tell us about option A.
Okay, option A, and I want to point out that when an employee is first hired, the employee has 60 days to enroll in the optional coverage A, B, and C, which we'll talk about. And again, without furnishing evidence of medical insurability, there's no medical exam, just like there is with the basic insurance amount. But I do want to say that with the basic insurance amount, an employee is automatically enrolled in that, and unless they decline it, they're going to have the basic insurance amount. With the optional coverages, they actually have to formally enroll in it in order to get that. And again, within the first 60 days, they can enroll in A, which is standard, a flat $10,000. Flat $10,000. Employees pay the entire cost of the premiums, so there's no government contribution. It's a flat $10,000, also known as standard, option A standard.
Mm-hmm.
Option B is a multiple of an employee's SF50 salary as adjusted. The adjustment is as follows. Take the SF50 salary and round it up to the next $1,000 and add $1,000. So back to my example where the employee's SF50 salary is $87,200. Rounded up to the next 1,000 is $88,000. Add 1,000 is $89,000. An employee could choose 1, 2, 3, 4, or 5 times that amount of option B, those number of multiples, and the amount they're paying in premiums will be determined by their age.
Okay, so that does move with age, unlike basic.
It gets more expensive as an employee gets older, and it gets significantly higher. I want to point out by the time an employee reaches in their 60s.
Okay. For any of you feds out there scratching your head right now saying, why do they have the 10,000? That's not much. That option has actually been around and in place since the late 50s and early 60s. So in those days, $10,000 could actually have been a multiple of a federal salary or a home mortgage. And again, little nerd moment here. Option B actually came to you courtesy of President Jimmy Carter and the Federal Employee Group Life Insurance Act of 1980, which he signed into law. Now, Ed, you touched on this before, and I want to touch on it again. So just like basic, every Fed pays the same regardless of health, even for the options, even for basic, correct?
That is correct.
Okay. And so if I'm a smoker, I'm probably having my rates averaged away and averaged down. And if I'm non-smoker, I might be averaged up a little bit from what I might expect to pay, say, in the private sector.
That is correct. That's why I advise employees when they come into the federal government and they need life insurance, and they enroll, let's say, in the FEGLI basic. Through the years, they should evaluate their life insurance needs, but if their health continues to be okay, they should check into buying some individual term life insurance with an independent broker, life insurance broker, just to compare the rates, because
Sure.
they might be saving a lot of money by paying by having an individual
Sure.
life insurance policy versus staying in the group.
So that's something I'll probably want to discuss with my advisor.
Certainly do not drop and certainly do not drop the FEGLI until you have something else in hand.
Oh, absolutely. Never give up what you have until you know what you can get.
Because once you drop out of the FEGLI, you in order to get back in, you have to wait for either a life event or a open season, which does not happen that often.
Okay. And there's one more option, option C. And that also came in the 1980 legislation. Why don't you walk us through that?
Okay, option C is called family coverage. An employee can insure a spouse and children in multiples of 5 times, 1, 2, 3, 4, or 5 times. For a spouse, it's multiples of 5,000, 5,000, 10,000, 15,000, 20,000, or 25,000. And again, the cost it depends on the age of the employee, not the spouse, It's there are different tiers of they have premiums depending on the age of the employee, and for children, it's also dependent on the age of the employee in terms of what it pays. And you have multiples of 1, 2, 3, or 4 times of $2,500. You can have 2,500, 5,000, 7,500, 10,000, 12,500 on a child. Whatever multiples you have on a spouse, you have on a child. I do want to point out, and many employees are not aware of this, that when a child turns 22, they are no longer insured.
That's right.
It is the responsibility of the employee to remove that child from coverage. And you can remove a child from coverage, just like you can decrease the amount of your FEGLI coverage. You can get rid of the optional coverages or decrease the number of multiples that you have, let's say in option B, at any time. You don't have to wait for an open season using standard form SF2817, SF2817. So if you have a child who's under option C and that child is, let's say, reached his or her 22nd birthday, please remove that child from coverage because they are really no longer insured.
Sure. And is it true that if I'm raising my grandchild as a foster parent, that child could also be covered?
If that child is considered to be a dependent, yes, you can. You can include, just like there are death benefits for children for employees who die in service. The grandparent is raising a child, and child's under is considered to be a tax dependent of the grandparent. Yes,
that's a very generous definition. Okay, I think that gives our listeners a good primer. So let's jump into the mechanics. You already gave us an idea. I'm a Fed. I want to sign up. I'm going to get basic automatically unless I waive it. Then I make decisions about A, B, and C. Now, if I waive everything when I'm first hired and I want it later, I'm not completely out of luck. You said there's other things where I could get that in?
There are open seasons for FEGLI, which occur not too often. I'll give you an example, Dan. The last open season for FEGLI was September 2016. The one before that was September 2004. The one before that was 1999, and the one before that was 1992. FEGLI open seasons are not held that often.
Wow.
But if an employee has a so-called life event, they could enroll in FEGLI. And again, when we say enroll in FEGLI without having to furnish evidence of insurability, this is what happens during an open season. You're guaranteed coverage. For FEGLI during an open season and during a life event, you can get into FEGLI without having to prove that you're insurable. So again, what is considered to be a life event? You get married, you have a child. Believe it or not, if you get divorced, that would be considered to be a life event. You could increase the amount of your FEGLI coverage.
Adoption also?
Having a child, I believe, yes, it does. Okay, it does count.
So, and that goes along with, now, do I have to do something unusual if I want to reduce my coverage? Do I have to wait for an open season? Do I have to have a life event?
No, unlike adding to your coverage, if you want to reduce or entirely get rid of your FEGLI coverage, you can do that at any time by filling out and submitting to the Office of FEGLI Standard Form SF2817, SF Standard Form 2817, which can be downloaded from the website www.opm.gov. federalemployeesgrouplifeinsurance.gov/forms. Can be done at any time.
And folks, I got to tell you, Ed pulls these forms from memory. I've seen it in action. If you get a chance to come see him live, you'll actually be able to see it in person, so you can be sure that I'm telling you the truth about that. So any other ways that FEGLI could terminate without me choosing to waive it? If I leave service, stuff like that, it goes away?
If you leave federal service, yes, you lose your FEGLI. You have an option, though, of converting your FEGLI before you leave to what is called a whole life insurance policy.
Okay.
It's a little tricky, and it's also very expensive.
Okay. But say I had a health issue and I was leaving for that purpose and not retiring, I wouldn't necessarily be stuck.
That's correct. You have an option there.
Yeah, Feds still have options. That's great. Wow, there's a lot more to FEGLI than most folks think, and you'll be back on our next episode to talk about FEGLI in retirement. Correct?
Yes.
Okay.
Yes.
As always, Ed, I can't thank you enough, folks. Be sure to listen for the next installment with the guru, Ed Zurndorfer. Topics in our podcast for informational purposes only and should not be taken as advice. The opinions of our guests are their own and not necessarily those of Serving Those Who Serve, Fedlife, or Raymond James. Interesting dates and tidbits quoted by me can be found in the Federal Register in entries spanning from 1954 to 1994. We are Serving Those Who Serve. Be sure to subscribe to our podcast on our YouTube channel, and remember to share it with your friends and strangers. Check us out on Twitter and LinkedIn. And don't forget our seminars every month around the DMV featuring the one and only Ed Zurndorfer. Ed Live is an experience you don't want to miss. So for more information, go to stwserve.com and click Seminars and Events. Be sure to read Ed every month in the Fed Zone, also at stwserve.com. So for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one because you deserve it. We are out.
Thank you for listening to the Fedlife podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.